Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining me. And yes, I am back from Greece. Had a great break, bit of business in London first and then a bit of a break in Greece. Very hard coming back to normality after those wonderful days sunbaking and swimming in the wonderful waters of the Peloponnese. But still, I'm back and I didn't take my eye off the markets, and I would like to share with you what I think is going on. But before I do that, let me tell you who's on the show tonight. We've got Jun Bei Liu from Tribeca Alpha Plus. I'll be seeing how she's investing right now. Then we have Anthony Doyle of the fund manager Fire Trail, and we'll look at all the big issues that you need to be aware of if you're making decisions about whether you should be investing right now or whether you should hold fire and wait for some big information to be released, particularly out of the US this week and in coming weeks. And then we'll talk to Angus Moore of PropTrack to see what's going on in the housing market at a time when house prices are about to fall. I noticed that Baron Joey, the fund manager, apparently is talking about a 25% fall in house prices. I think that will probably prove to be wrong, but you know, it's guesswork when it comes to this sort of thing. So before I kick off the rest of the program, let me just give you a few ideas about what I think is going on right now. The big story for this week will be the Federal Reserve on Wednesday in the US, so therefore we'll find out what happens on Thursday. Will they raise interest rates by 0.75% or by 100 basis points or 1%? If they do, I think the stock market will really be negative about this. If they come up with a more nice view on the future, well then the stock market might like it. But I'm not betting that the Federal Reserve will be saying anything that could be soft or accommodating, and so I'd be holding my breath and holding my money till I see what they have to say on Wednesday night, effectively our time, and therefore Thursday morning our time. I personally have recently invested in a company that I thought was a really good company that had been really over smashed by the market. My view is that this company was certainly priced at a very low level, and I think this time next year I'll be very happy that I've done that. I also got confidence from the fact that a guy by the name of Dustin Moskovich, who's the CEO of a company called Asana, a big US company, recently invested $349 million into his own company. I love to see a CEO who really backs his own judgment and backs his own company. And a lot of CEOs are doing that sort of thing at this moment. And I think it's a confirmation that a lot of smarties really do believe that prices have got too low. That's part of the reason why I think Tyro received an offer from private equity, because the share price got too low, and private equity knows that in a year or 2 years' time, a company like that is going to be doing a lot better when the stock market's on the rise. In the Switzer report, in fact today, I wrote about 4 or 5 companies that I think are really great quality companies have been beaten up by the stock market. One is Goodman Group. There the analysts think there's about a 27% rise going forward. I think ANZ is not a bad bet. Credit Suisse and Citi think there's a 23% rise ahead for a company like that. Xero is one of the best tech companies in the country. One analyst thinks there's a 77% rise possible for Xero. Got JB Hi-Fi, without doubt the best retailer in this country. Big rises predicted for JB Hi-Fi, around 12% on average, but there are some with much bigger predictions. And you've got South32, a good diversified miner. I think this is a company that could also do well because of its diversification. This chart here, this table, actually shows you what all the analysts think about South32. Look, every one of them like the company, and the range goes up from 34% to 36%, and the lowest is 15%. So you can see most analysts think this is a company heading in the right direction. This is the right time, as long as you're a long-term investor, to look around for those quality companies that even if you get it wrong in the short term, you're still holding a good quality business that over time will be very rewarding. So that's my take on where we are in the market right now. Anthony Doyle will also give you his take when things might improve for people playing the market. But for now, let's go to Jun Bei Liu of Tribeca Alpha Plus. Well, it's a tricky time for the market right now. It's all caused because of the inflation number in the US. Let's just see how Jun Bei Liu is reacting to it, how she's investing as a consequence of that number. How are you going?
I'm very good, and I think, based on your question, that I'm actually turning a little bit more bullish at this point now.
Okay. So were you a little bit negative last week when I was away?
I was away. I was in the US for a couple of weeks. Look, the market rallied very hard, remember, in July and everything, and that's when we chat earlier. And there was just a little bit of exuberance in terms of, we had a terrible June, now we just rallied back. Reporting season was okay, it was pretty good. Yeah. And then markets sort of become a little bit complacent about where the rate is going, and then the long end rate started falling and things. So you kind of just see tactically there's a bit of short-term sort of risk volatility to come. And then now you see that come out quite quickly. A lot of expensive companies and cyclical companies being sold off a lot on the basis of we are start seeing a bit more profit warnings out of the US. Still, conditions still pretty good. I just got back from the US, went to consumer conference and seeing a couple of other businesses. Things are still going pretty good, but they are, especially the retailers in the US, are now becoming a little bit worried about next couple quarters because they're all holding a lot of inventory like us, but they're further down the track because they're lower end. They said the bottom quartile consumer are now really struggling quite a bit.
Yeah, but in many ways that's a problem on one hand, but should be a good thing for inflation, shouldn't it? If inventories are high, retailers will start slashing prices. That will filter into inflation and then filter into interest rate expectations, which could be good for the overall stock market.
But possibly. So next few quarters, you'll start seeing discounting. By March next year, discounting will be severe because, past the peak season, everything needs to be cleared. Only thing is, though, labor cost seems to be on the way up. That's very difficult to control, and you can't pass that on. So, but that's the only inflationary pressure that's kind of looks like a little bit structural at this point, but everything else seems to be falling away quite quickly.
Okay. The inflation number last week was disappointing. I know some indicators suggest that US inflation has peaked, though it's not showing up in the official data yet. If we got a better than expected number on October 13, do you think the market would really love to see that?
Oh, absolutely. Markets looking for some signs of stabilization, of things getting better, just coming off the peak. And that's why in the UK and Europe that people are very worried because inflation is still escalating. And the last inflation read in the US, the thing is that some of the core inflation look like it's just creeped up a little bit. So that's why it got market concerns. My view is that it should start to come off now. Every company we have heard from have talked to, consumer a little bit tougher, and every forward indicator, it's just a matter of time before we get there for the US.
Yeah. Are you investing now, or do you want to wait to see what the Fed says on Wednesday?
No, I actually think now is the time to start buying those businesses that's been sold off. For me, I think to be defensive is important in this market, but to be defensive is not about buying, supermarkets or, these type of businesses. It's actually buying about some of the quality growth companies because they will grow regardless whether there's a recession or not, right? So, healthcare sits well in that space, and some of the technology businesses sits well within that businesses. And if we do have inflation started coming off, and just given the bond yield has just jumped significantly, I do think there's a bit of quite a bit of upside just even in the short term for those structural leaders.
Okay, let's just talk about some quality companies that have been beaten up. Like for example, what do you think of a company like Goodman Group? It's dropped a fair bit. I think it's probably the best REIT in the country. What do you think about it?
Yeah, look, it's funny you ask because I'm actually just buying some Goodman Group today. Look, you can. The thing about the valuation is that I think it has, given my views of bond yield, I think it's peaked, and going to 4.3% long rate for the US, it's pretty much done. And for quality company like Goodman, devaluation is done. So what you're buying now is earnings growth. And I just went to the US and we spoke to every asset manager. We spoke to so many things. There's a lot of demand still for industrial spaces, You know, and then the demand is not going to evaporate that quickly. Demand for, you know, the data centers, demand essentially the big box, those sort of industrial land size is very, very tough. You know, there's so much competition. So I do think that public listed players such as Goodman Group is very much undervalued at this point.
Now, we all accept that retail is going to be under a bit of pressure as people chase services like going overseas to Greece or whatever.
That's right.
But for those people who are long-term investors, is a company like JB Hi-Fi in the buy zone for that sort of person?
I think so. However, I do think the share price probably is just not going to go anywhere.
Yeah.
You know, if you put a bottom draw, it's fine.
Yeah.
Cash flow will be pretty good. And I think, you know, in Australia, still got a couple of good quarters to come. Yeah. And next year, calendar year, is probably when you start seeing some weaknesses. But the stock is on 12 times. It's very cheap. Good cash flow. Probably will be more dividend buyback and these sort of things coming through next 12 months. So it's probably just not going anywhere. And for the long term, I do think it will add value.
You mentioned tech. Is Xero a company you still like?
Oh, absolutely like Xero. So
it keeps touching. Price,
that's right. It just keeps staying in that price, and this is in my buy zone range. Yeah. You know, before people, you know, always say, "Oh, when do you get the very bottom?" You never get to the bottom. So you only buy. You work out a price you want to pay, and then you buy it. And this is in this range. Business still doing very well. More recent update, it did have a bit of disappointment because of the reopening is a little bit slow for some of the SMEs. But net, the business is doing very well in terms of long term. Winning markets in the UK, already won markets here and the markets in the US.
I noticed that a lot of US CEOs have been buying their own companies' shares. Is that generally a pretty good sign that they at least think the market's mispriced their company?
Oh, absolutely. They always say there's two things, so they can buy or sell their own shares. They can sell their own company shares for many reasons, divorce, tax, so many reasons.
But divorce is often one.
That's right, often one. That's right, or buy houses. And but buy their own share, there's always one reason because they feel good about the company they're in. So you know, and it's just such a strong signal that things are going well. Not necessarily mean they know the numbers, but they know there's a good vibe and good things are happening.
Yeah, and they know that the market
is undervalued.
Yeah, is undervalued.
Absolutely.
What about when private equity wants to buy a company like Tyro? You and I have talked about
right,
Tyro.
Absolutely, yeah.
And we've often said, well, it even looks like a takeover target. And sure enough, along comes private equity and throws in an offer. Is that often a good sign that the smarties think, well, this is a company that's mispriced and they're happy to get in if they can get in a bargain basement price and ride up the market over time?
Absolutely. So this is the investor base. The private equity is the investor base that can take really long-term view. Not like the listed equity market investors tend to be, oh, you know, got the next 3 month or whatever performance. So they can take long-term view, and we will see more and more that coming through the mergers and acquisitions. And I've been told that there are a huge pipeline that is coming through in the next few months.
Would that coincide with a belief that the interest rate rising cycle created by the central banks is pretty well close to the top? You already mentioned you think that the long bond rate has already peaked. So once you have certainty around what you might be borrowing at, and then you look at assets that you think are mispriced, does that sort of set itself up for a big takeover surge?
Absolutely, it set that self up, and also at the same time, so it's easier for them to do the valuation of the business they want to buy because they know how much they're already locking in the money. And also at the same time, it has, you know, invariably created the volatility in the share market, and they can buy those listed shares so much cheaper because of the higher interest rate. And all, you know, we've seen the share price. What share price done? You know, Goodman Group and Charter Hall, all these names have fallen significantly. So we definitely going to see that.
Okay, many years ago, when I interviewed Renee Rivkin, Renee always said that, you know, the first offer on a takeover is generally not the last. Do you think Tyro will see another offer?
Absolutely. Normally they flush out more buyers. The first one is always opportunistic, and you know, they put a price out there, see how they go, and clearly, you know, you've seen where the share price has gone, and this is a very little premium relative to the last 12 months share price, really. So absolutely, there will be more coming through.
All right. What do you like? What's the most liked company that you've bought recently? You already mentioned one, but what's the one that you really think looks fantastic?
Look, I think just following up from the reporting season, the Treasury wine was a really good result.
It was.
Share price, went up a little bit, but still, there's a lot more to go for the price. It's
Does it need China to start being nice to Treasury wine, or they've found new customers?
They found new customers, and then China will be additional bonus. If the China does come through, share price will put up another 30% very quickly. But they found new markets, and then they've done really well in terms of their premium label. They're in the US. I just come back from a trip to see some of their vineyards and their competitors. Things are going very, very well there. That premiumization trend is really going very well. And brands like Treasury, it's very Penfold, it's very prestigious.
Okay. Well, I don't think I've ever pointed out a stock that kind of was a bad tip from you, because you never make bad tips. But both you and I fell into A2 milk, and it's starting having a nice recovery.
That's right.
What are you seeing about the recovery? Is it giving you confidence that it's on the uptrend now?
Yeah, so I do like A2 as well. That's another name that I think it's being neglected because things have been so tough. We're seeing them taking share from the result. Great balance sheet still. Lots of net cash just sitting on the balance sheet. China's recovering, taking market share, and
what about the US prospect? Are they going to get into the US market?
Yeah, US look, it's tough. So they got their milk business over there. That's kind of break even-ish. The infant formula, they kind of missed that boat in terms of the initial those tins to supply the shortage. But look, US is going to become a very, very tough market because amount of people have gone in there now as a competition. So it was never going to be material for A2 for the next few years, even if they got in, even if the license turned into long term. So it was never going to be that material for this business. China is a very big deal, and then the rest of the world potentially will go in.
Do you ever, before you go to sleep, rather than thinking about individual companies, think about big issues like China? Is China and Australia going to get better relations, and as a consequence, more tourists come back, and A2 milk, students,
That's right.
because it's great for the labour market. Are you sort of thinking that maybe the Albanese government will have more of a chance to win China over, but also China says a few things positive, so it makes it easier to accept some of their unusual ways in recent times?
Look, I certainly feel that they at least started talking. So previous government, they weren't talking. So the relationship got pretty icy. Look, if you look at use the example of China with its own neighbours, the relationship it has with its own neighbours all go through rise and falls, and sometimes last for decades. But if you look at the trade China has with other markets, its neighbouring markets, just been going from strength to strength. So there may be 1 or 2 years of blip, but they always return to the commercial terms and trade. I never ever make you talk about mining, but do you invest in miners if you think they're a good buy? Yeah, I do invest in miners. Mining is a very different sort of beast when you talk to that whole sector compared to the quality growth structural businesses, because mining businesses are very much driven by macro, the top-down view of what the commodity does. It doesn't really matter what business it is, the commodity is down, the share price is down. So it's very much top-down, so you've got to have a pretty clear macro environment. So right now, mining, I must say, I'm a little bit more neutral-ish on that space. I still like the battery materials, but they have run pretty hard. So, if anything, I'll probably take some profit in that space. But the rest of rest of the mining sector needs China to stimulate aggressively, and China is stimulating. The problem is the economy is not reopening fully yet. So if anything, probably early next year, you should see sign of revival from, in terms of China's growth. And then that's good for our mining stocks. What do you think of a company like South32? Look, I think it's... I actually have a little bit of South32. I like it for diversification. Yeah, that's right. No, I'm not totally excited that it will shoot the lights out, but it just seems it has nickel, it has copper, it has metallurgical coal. All those sort of things seem to have life going forward. Yeah, look, that's right. It's got all those little bits doing well, and also it's got all that exposure to alumina, and then the prices, which is really, that's right. And then it's very cheap. So this really sits at that value end of the commodity space, and because it's so cheap that you're actually getting really good dividend and things on top of it. So to me, it's actually in a way very defensive nature of those businesses compared to the battery material, where earnings probably much further down the track.
Okay.
Yeah.
Let's wrap this up by looking at 2023. And you can say, Peter, you're totally wrong. But I know on one hand, the fear is that interest rates go too high and the US falls into recession. That won't be great for stocks, I wouldn't have thought, from the lead that would come out of Wall Street. But if the Yanks can avoid a recession, we've got, in the context of interest rate rises ending, either early 2023 or even before, you've got the possibility then that the market will want to go up. Are you expecting 2023 to be a good year for the stock market?
Look, I think it looks reasonable if we don't have recession in 2023, because if we do have recession, then all bets are off. We have to reset. The earnings too high. Earnings not priced for it. Otherwise, if you look at interest rates sort of expectations already in the market, we've already gone through the first aggressive pickup in the interest rate. By next year, we're sort of more gradual to wait and see sort of environment. So things are not too bad, and hopefully by then, inflation, big part of inflation is coming off. The
supply side of it.
That's right. Yeah, that's coming off, and then the and then the soft commodity prices already started falling off as well. So consumer may be in a better place.
And what if Ukraine war ends?
Yeah, absolutely.
Would that be good?
That would be really good. That would be fantastic. Only thing is the sanction might not be lifted very quickly. So that sort of still provides restriction at that point.
But I suspect if Putin is prepared to end the war, then he'll have a negotiation.
Yeah, that's right. That's right.
Absolutely.
Absolutely. You're right.
Okay. I guess it's always valuable to live in hope.
That's right.
That's Jun Bei Liu of Tribeca Alpha Plus Fund. Well, it's a big week, once again, coming out of the US. The last time something came out of the US was the inflation number last week. That didn't help the markets. Before that, Jackson Hole, another Federal Reserve problem for the market. Will there be another problem later this week? Anthony Doyle from Fire Trial, great to see you, mate.
Cheers, thanks for having me back.
Are you worried about what might come up on Wednesday American time?
So last week was all about the inflation data. That really nailed on the 75 basis point increase that we're likely to see from the US Federal Reserve this week. So there remains hope that we're likely to see the peak in inflation. Last week suggested, guess what? It's probably going to stick around a little bit longer than many had anticipated. So the Fed really trying to crunch demand. They don't want inflation to become embedded in either wages or headline inflation. So that's why we're seeing higher interest rates right now. The market doesn't like this uncertainty. That's why it's volatile.
Are you of the belief that 100 basis points a possibility?
It's interesting. So I looked at the consensus forecast this morning. 10 out of 50 professional economists are expecting exactly that, including some of the big names on Wall Street. So it's not out of the realms of possibility. The market's pricing in a 0.8% increase. So they're hedging their bets, as you would expect. But the consensus very much 0.75% increase on Thursday.
Because you are an economist, you know that there are really hard to work out lags when it comes to monetary policy, raising interest rates. I wrote today that even our Reserve Bank said the lag can be 1 to 2 years. Is it really a possibility that the Federal Reserve in particular is going too hard, expecting a quick bang for their buck, and it may well happen in April or May next year because they've actually hit pretty hard?
Absolutely, Peter. You know as well as I do that monetary policy does operate with a lag. It does take time for households and businesses to factor in a higher cost of credit. And additionally, it takes time for these interest rates to roll through. As many Australians are facing right now, it's a 3-month lag from the RBA cash rate day to when the mortgage actually jacks up your mortgage.
You start losing money.
You're absolutely right, Peter. So it will operate with a lag, and what you tend to find is the economy is already slowing, and that may have a double whammy effect.
I was interested, I don't know if you've seen Shane Oliver's AMP pipeline indicator, and That's kind of for the last 3 months been showing that inflation is falling in the US, but the official data only started to fall a month or so ago, and only by a small amount. And so it's raising the question in my mind, is it possible that on October 13, when we get the next US inflation number, we might get a surprisingly better number because it's been in the pipeline and the official data catches up?
Well, it's interesting how much focus there is on year numbers. So why isn't it 13-month numbers or 14-month numbers? But inflation is predominantly food and energy. And we know that commodity prices have declined. We know that energy prices have fallen to an extent. And we know that those year-on-year base effects are starting to roll through now. So that's why the market was so disappointed last week, as they did expect that we'd seen the peak and we may begin to start to see a receding of inflation, exactly what you're describing now.
And also rents are pretty big in America too in terms of the CPI. Apparently they're on the slide as well. Not here apparently, but definitely in the US. All right, so let's just set the scene for people who don't really understand how economic data can really help or hurt the stock market. If, for example, on October 13, we actually do see a better expected number, would you expect the stock market to react in the opposite way to how it did when last week's inflation number came through?
Yeah, so predicting and trying to make money off these variables is an extremely difficult thing to do, particularly in the short term. And I know that you advocate, that long-term perspective, as we do at Firetrail, certainly. But how the market reacts to a given economic data point, I mean, the market's been described as manic depressive sometimes, other times eternally optimistic. So I think this market is very much characterised by the glass half empty. The market is quite pessimistic today, but certainly what has got everyone up in arms at the moment is just when are interest rates going to stop rising? Whether the pace of those interest rate hikes slows or not remains to be seen, but that's what got the market up in arms today.
Does monetary policy or interest rate policy work better in Australia because a lot more of us have variable home loans compared to the Americans?
So that transmission that we spoke about earlier, the potency of monetary policy in Australia is far greater because so many mortgages in the US are priced off a 30-year fixed mortgage rate. And of course, guess what the Americans did when interest rates hit rock bottom lows, as we all would. So today the 30-year fixed mortgage rate is around 6%, but everyone's locked in their mortgages. So the way that the Americans and the Fed like to impact aggregate demand is by hitting, guess what? The stock market and the bond market. And that's exactly what they're doing. In Australia, of course, our fixed rates of 3-5 years or variable rates, that monetary policy transmission, that hits our balance sheets much quicker. And this is why you may see a divergence between the RBA and the Fed. The RBA has already started to plant the seed that they might start slowing those 50 basis point increases, whereas the Fed, there's no end in sight.
And I guess it's fair to say that they probably hit those consumers who are looking for sort of personal loans because their rates would change, and also business would cop it as well because they borrow at current rates.
Absolutely, yes. So for anyone interested, they can go on the RBA website today, and the RBA is doing a great job of highlighting where household interest rates are, mortgage rates, but also small, medium and large business rates as well. So showing that transparency and that visibility.
Okay. We know the market is caught between the fear around inflation not peaking as soon as we like, and therefore more interest rate rises, but also the fear of recession on the other side. What's the chances of a recession in the US? High, low, or in between?
I'm putting it at a 30% probability today.
Low.
Particularly, and that's rising as we see the Fed funds rate increase. But globally, there's certainly concerns emanating from the US, Europe with high energy prices heading into winter there. The UK is probably as pessimistic as I've ever seen. You've just come back, but 24 months of recession predicted there from the Bank of England.
And 18% inflation, City was predicting was unbelievable.
Yeah, and Australia actually, we're pretty well positioned. We aren't facing those ultra high energy costs as an energy importer. We're not facing rampantly rising agricultural costs as we have a huge food basin here as well. So Australia, again, that's why the RBA may actually peter out their interest rate hikes sooner than other central banks.
So your view on recession here is very low?
Much lower than globally. Obviously, we're a small open economy. A global growth slowdown will impact us, particularly with China now stimulating again. If they start to stimulate, that will help us. But certainly, I think the US 30% and rising.
Okay. Now, this is a very easy thing for you to predict, the Australian dollar. But a lot of people want to know because they're saying, particularly if they believe that, okay, there will be a turnaround eventually, and US stock markets will probably start to rise eventually if it's not late this year or 2023. And a lot of locals are saying, well, should I be hedging on the basis that the $8 could rise and the US dollar could fall? What's your view on Aussie dollar, US dollar, say into mid-2023?
So the main determinant of currencies are interest rate differentials. So the difference between where the RBA cash rate is and our bond curve versus the Fed funds rate and the US Treasury curve.
Yep.
So for the next 12 months, I'm bullish on the dollar, particularly...
That's the US dollar.
The US dollar, of course, yes. The reason being that as interest rates are rising in the United States, much like here, guess what? Suddenly it becomes a lot more attractive for Americans, the deepest pool of capital in the world, to repatriate their international holdings and bring them home and invest in US dollar denominated assets, whether that be a deposit with their bank or whether that be local assets like their housing market, the equity market or the treasury market. In Australia, as I mentioned, a small open economy, we're very much seen as a risk currency. It's a way that we have quite high exposure to emerging markets via China. And with this environment of uncertainty, risk aversion is high. So people love the safety of the US dollar, and I think that remains for the next 12 months.
All right, so after the 12 months, will the focus then go on to the size of the US budget deficit, which also can be a reason to bring the US dollar down? Is that going to be another factor that we factored in over time?
Yeah, it's always a factor. Particularly we saw back in 2012 under Barack Obama, the US lose its prized AAA credit rating. And we remember the emphasis that the market had placed on that. And guess what happened when it lost it? The US dollar markedly rose because investors became concerned again. The US benefits from that reserve currency status, particularly in an environment like we have today.
Okay. You'd be surprised to learn that I think that the Australian stock market will start to improve sometime in the December quarter. That's been something I've been saying for quite some time. Do you agree?
I mean, our view is it's time to dig deep and find those winners from the market at the moment.
Yeah, the sell-off has provided opportunities. Yeah.
Absolutely. There's some fantastic companies there. And one statistic that I like to talk to investors about and our clients about is that on any given day, there's a 54% likelihood that you'll make money in the stock market.
Why 54%?
Stock markets rise over time, right? So this
but
is
why
going
54%. Like why is it 57.2?
54 up days, 54 up days out of 100, and 46 down days out of 100.
Right.
But if you extend your time horizon in total return terms, over the course of 5 years, an investor in the Australian stock market with that time horizon actually has always generated a positive return. So it is time to dig deep. It is a much tougher environment. That said, we think that the opportunities are far greater today than they were 18 months ago in a rampant bull market when everything was expensive.
And of course you're saying invest in quality stocks or quality funds.
Well, absolutely. We have the Firetrail Australian High Conviction Fund, Small Companies Fund, and of course my fund, the Firetrail S3 Global Opportunities Fund for the investors looking for that global equity exposure.
In the end, and people do need to have international exposure. How do you manage the $8? Because you're kind of implying you're expecting the dollar to take off. So how do you manage that?
So our fund is unhedged. We also offer a hedged version for those clients that want to hedge against the Aussie dollar rising. So we offer that. We also will take out currency forward. So we'll hedge where we think that currency is going to swamp the good work that we do on stock selection. So we currently have a hedge on at the moment, Euro versus US dollar, which has benefited the fund as Euro has sunk through parity with the US.
Thankfully for my holiday, it was very nice.
Yes, of course. Excellent, excellent.
Okay, on that subject then, is Europe something that you're holding back on? Because we know eventually when the Ukraine war's over, Europe and the European stock markets will benefit from it ending, but we don't know when it's going to end. So it must make it very hard for you to overexpose yourself to Europe.
We actually are overweight Europe today.
So you're gambling on Vladimir Putin.
No, Peter.
You're a very risky player.
We're investors, we're not gamblers. Okay. But let me give you the rationale behind that overweight to Europe. Firstly, as you mentioned, it's extremely cheap. Yep. We're valuation managers. We invest across value and growth. Okay. So we're not biased towards tech companies. We're not biased towards utilities. We invest simply where the best opportunities lie. Today, we think that is in Europe. That's why we're overweight. Yeah. But another significant reason is the companies that we own are large international conglomerates, and their revenues are in
export income,
ex euros. Yeah. So when the euro is falling, that actually benefits these companies. So an example is a leading train manufacturer, Alstom, French-based, but 80% of their clients are based offshore. So the fall in euro has benefited many of our European portfolio holdings. So that's how we think about it.
What about European banks? How are you playing those?
No exposure. No exposure to European banks.
Okay. All right, so let's go to the likelihood. You are saying to people, it's time to buy. Would you be surprised if there's not an end to interest rate rises in the US in particular before the end of the year? Would you be surprised if it's not over by then?
I think that we start to see language come out of central banks as they try to manage the market, that the pace of interest rate hikes will begin to slow, and we'll start to see the peak in the Fed's fund rate, probably Q1 next year, I would suggest. The RBA is closer to potentially pausing on their interest rate hiking cycle, but we might see a very bad CPI print in November, late November.
Which will be bad.
We'll get a Christmas present from the RBA of potentially another 0.5% cash rate increase here in Australia, bringing our cash rate to around 3.35%. So I would be surprised if we see the peak in the Fed funds rate this year. I think it's probably going to come around Q1 next year. And we're operating then in an environment where I don't expect that interest rates will fall for some time, potentially as long as 12 months after.
Will the market require it actually seeing inflation falling, or if the language coming out of the Fed's good enough, the market will react to that?
Well, the market will want to see the Fed change their forecasts, first and foremost. And it's extremely difficult for the Fed to start talking about lowering interest rates when the inflation rate is 8.3%. They're petrified of an inflation-induced spiral, that they take their foot off the brake too soon and inflation starts to pick up again.
All right, last question. If you look at US inflation, and you can actually say, I don't know, but what percentage of that inflation is demand caused, and what percentage is cost caused?
Well, in terms of headline inflation, you're looking at around 60% from supply side factors.
That's cost.
That's exactly, and then 40% aggregate demand. Central banks, they can't impact the global supply chain, they impact demand. That's where monetary policy works. Increasing the cost of capital on consumers and businesses. And then you also have the double whammy of the federal government beginning to tighten their fiscal reins as well. So that's where they want the impact to occur, and that's exactly where it is going to occur.
So if we rule out a recession happening, is it possible, and this is, by the way, this is the second last question I'm asking you, I've already asked you the last question, is it possible then that we could see the impact of the interest rates really helping to bring down the demand-driven inflation, and at the same time, a lot of those cost problems that came out of China and all the COVID-related ones also dissipating at the same time, and there could be a shock drop in inflation, which would be an enormous stimulus to stocks, I would have thought.
Yeah, of course. I mean, it's entirely what you see in every cycle and every commodity-based cycle back to the 1970s. Prices rise, supply responds, demand falls away as price is high, and guess what? You've got a glut then. This is a classic market response.
Yeah, okay. And so that could be a really good thing for lots of stocks, particularly tech stocks that have been smashed because of high interest rates.
We're not there today, but it isn't without the realms of possibility of occurring.
Have you got any tech stocks in your fund?
We do, yes. We've got some growth names. So we have HelloFresh, which I'm sure many people are familiar with. European, German company.
Okay. It sounds very German when I think about it. I accept it as an Australian ad, but that's very German.
You should sign up. Great meals.
You're showing it too.
We own Microsoft as well.
Yeah.
So one of the larger names.
Good German company?
We own a company
I'm
named
joking, of course, by the way.
company named Tenable, which is specialises in cybersecurity software.
Yeah.
As we've all moved to working from home and thinking about the risks that go on with cybercrime, for example.
So you're investing in the US as well as Europe in your
Of
fund?
course, yeah.
Okay, well, one last. There's two companies I want you to talk about then. This is your third last question. Tesla and Zoom. What's your view on those two companies?
So we are doing the work on Tesla at the moment. So the exposure we have to EVs is via Volkswagen today. Trades on a PE of 4 times, and we're actually doing the work on Tesla right now. So when I come back, I can definitely give you a view. Zoom, we haven't done the work on, no. So
it seems like a company that should benefit from all these people wanting to work from home, but
well, I mean, our exposure there is via Microsoft, right? So Microsoft, leader in the cloud, one of the leaders via its Azure product, now passing on price increases in the Microsoft Office suite of products as well. And I'm not sure about Switzer, but we're using Teams rather than Zoom. So Microsoft obviously dominant.
We're flexible.
Of course, I wouldn't expect any less.
Okay, good to see you, Anthony.
Cheers, Peter.
Anthony Doyle of Fire Trail.
My next guest says that activity in the property market is actually increasing. Joining me now to discuss in his latest research report is Angus Moore. He's an economist with PropTrack, which is part of the REA Group. Angus, welcome to the program.
Good morning. Thank you so much for having me.
Yeah, so despite what we might be hearing, it looks like the spring is sort of coming out and listings are up and there's more activity in the property market than some of the doomsayers are saying.
Yeah, that's exactly right. There's certainly a lot of doom and gloom around given how quickly interest rates are rising, but we're not seeing that translate into property market activity, at least thus far. So we saw the number of new listings on realestate.com.au up 10% in August compared to July. Now, part of that's the fact that we're heading into spring. We'd expect to see activity ramp up. Spring is normally the busiest time of year and winter is among the quieter. So, we're starting to see that activity ramp up. But if we look compared to, say, last year, we're up very strongly. It's not a totally fair comparison because Sydney and Melbourne were in lockdown, as was Canberra. So activity last year was a bit quiet. But if we look at winter as a whole thus far, it's been one of the busiest winters in the last 5 or 6 years. So it has been quite busy despite those rising interest rates.
And do you have any idea where the activity is? It coming from investors or perhaps from owner-occupiers who are putting their houses up on market and potentially moving, or just try to sense of what's driving the pickup in listings?
Yeah, it's a great question. To some extent, we don't observe from a listing, who it is that's selling, but we can observe some things and get some sense of where this activity is coming from. So one thing we can do is look at to whom new mortgages are going. This year, it's been predominantly repeat owner occupiers, not first home buyers, which is a big change from what we saw in 2020 and 2021, when first home buyers were really very active, and that's not been so much the case this year. The other area is investors. We've seen a lot more lending to investors this year, suggesting investors are buying, but we've also seen a lot of sales from investors. We can match up properties that were rentals with their sales activity. And what we've seen this year is that, and last year as well, is that there has been a lot of sales of what used to be rental properties hitting the market. So investors have been a part of the activity that we've been seeing.
And there's also been quite a big increase in rents. So I guess that's partly driving investor activity. Does that bear out in your statistics as well?
Yeah, we've certainly seen extremely tight rental markets around the country. A number of rental listings on realestate.com.au is down something like a fifth compared to where it was last year, which is clearly significantly tighter. we're seeing advertised rents grow extremely briskly as a result, both in capital cities and in regional areas, particularly so in regional areas over the past year, but increasingly in capital cities as well. Notably, we're even seeing it in places like Sydney and Melbourne, which through much of 2020 and 2021, we really didn't see much growth in rents. In fact, through 2020, rents fell quite a lot in both those cities. And in fact, advertised rents are only back to sort of the levels that they were pre-pandemic in those cities. So while they're growing quickly, the levels of them are still only back to where they were a few years ago because of that weakness early on. That's starting to bring investors back in, which we're seeing in the new lending data. Gross rental yields still remain low because, as we said, rents are still actually, at least in Sydney and Melbourne, less so in regional areas, but rents are still not a long way above where they were pre-pandemic, and prices clearly have increased a lot since then. So gross rental yields have fallen a long way. That's starting to change as rents grow and as prices are falling.
And do you have any data, I guess, another indicator of, of market buoyancy is how quickly properties are moving, so days on market. What are the trends there in terms of how quickly properties are changing hands at the moment?
Yeah, it is a great barometer of kind of that balance between what we can see on market and how quickly buyers are having to make decisions. What we've seen over this year is it has started to take a bit longer compared to what we were seeing in spring last year or February, March this year. It's still below where it was in 2019. So coming into spring, the good news for would-be sellers is it's still pretty quick sales times, but we're talking, depending on how you measure, a bit over a month, month and a half, compared to more like a month earlier in the year. So things have certainly gotten longer, and there's some disparity across cities there as well. Places like Adelaide are continuing to see pretty strong demand. Not a whole lot of supply on market and pretty short sales times as a result. Whereas places like Sydney and Melbourne, we've started to see it increase a bit.
Now, early on, at least, there has been a lot of activity in, with sea changes or tree changes or whatever you want. That also came out of the pandemic. A lot of activity in the sort of the regions around the major capital cities. Are those areas now slowing a bit with in response to, the interest rates, but also perhaps some of the momentum out of COVID has gone and the urgency about people looking for a different sort of lifestyle and work-life balance? Maybe that's sort of moved on a little bit. What does your data there suggest about the buoyancy that some of the regions had?
Yeah, it's a fascinating question. And I think it's one of the areas I'm going to be watching really closely over the next 12 to 18 months is, do we start to see that unwind, that outperformance that we saw through COVID, or is this a bit of a permanent shift? At least to date, we haven't seen much in the way of unwinding. Regional areas, prices are continuing to grow a bit quicker than they are in capital cities. We're still seeing prices fall in regional areas, and that's basically because of the big headwind coming from higher interest rates. But relative to capital cities, regional areas have done reasonably well over this period. And even if we look within cities, outer areas have outperformed the inner city. So, in Sydney, that's places like the southwest. We've seen prices hold up better than in the inner city. Places like Melbourne, that's the west and Mornington Peninsula and southeast. In Brisbane, it's Ipswich and the west. In Adelaide, it's the north. So we are continuing to see a bit of that shift that we saw, people moving a bit further out, people looking for a bit more space. Now, whether that will continue, I think, is a really interesting question. My sense is some of this shift is permanent. We're not going to continue to see regional areas outperform in the way that they have over the past couple of years, but I don't think we're going to see a big unwinding either. I think for some people, living a little bit further out, living somewhere like the Gold Coast, Sunshine Coast, Central Coast, Wollongong, is possible in a way that it probably wasn't 3 years ago.
I mean, that's interesting about the movement out to some of the outer suburbs, because that's almost reversing a decades-long trend where all the price action was tended to be in a city and in suburbs very close to the CBDs, but we've seen that reverse quite substantially over in the last couple of years. And if that continues, I mean, that would have, I think a lot good news for a lot of homeowners.
Yeah, it's certainly been a really interesting trend over the past couple of years. I think the other thing that's worth mentioning here is the fact that a lot of the sources of demand for the inner city were kind of gone through the COVID period. It was much less attractive to live in the inner city for a variety of reasons. You weren't commuting, so there was no reason to live near, for some people anyway, so there was no reason to live near train stations. all the things that make living in the inner city, all the amenities really enjoyable, things like cafes, restaurants, sporting activities, those were all closed. Those are starting to return now. And importantly, migration was basically shut off through much of 2020 and 2021. We know that recent migrants to Australia are much more likely to live in the inner city, which makes sense. Many recent migrants are students. Many of our major universities are located in inner city areas. So it makes sense that we see those, demand for those inner city areas from those recent migrants. And we are starting to see that. If we look at rental searches on realestate.com.au, the number of searches coming from overseas is up about 70% compared to where it was last year. Now, that speaks as much to weakness last year as strength this year. Clearly there wasn't a lot of people looking for rentals in Australia at a time when Sydney, Melbourne, Canberra were in lockdown and the borders were firmly shut. But we are starting to see some strength this year as well. And we know from where they're searching that they are mostly looking for inner city areas. So we'll start to see some of that demand for the inner city come back over the next year, 2 years. To what extent, I think, is going to be really interesting to watch.
Yeah, look, it will be interesting to watch, and I guess a bit depends on whether the government can process some visas or not, but that seems to be one of the issues. Look, some really interesting insights, particularly about the strength of listings, and perhaps the market is not as bad as some would make it out to be. So that was Angus Moore, an economist with PropTrack, part of the REA Group.
And this is the show for tonight. I usually would say I'll see you on Thursday, but of course it is a public holiday, so we won't be operating. So I'll see you next Monday. Thanks for joining us. And don't forget, if you want to know more about the kind of stocks that we like, get more detailed information and more qualified information, have a look at switzerreport.com.au. And I should add that we also will be doing Mad About Money on Wednesday. That'll give you another chance for me to have a bit of a take on what's going on in the market.